Celsius stock has taken an absolute beating over the past couple of months. Shares are down 67% from their high earlier this year. And what we learned recently from a conference was that Pepsi has reduced their orders by about $100 to $120 million in the third quarter alone. That is a massive number for Pepsi, who is their key distributor. But there's a good explanation behind what's going on at Celsius, why Pepsi is making these decisions. So I want to dig into all of this today, kind of put this into context, because I think right now, Celsius' stock is actually priced more attractively than it has been for quite a while. We know more about what the future looks like. We know what the growth path is. It's just that we may be beyond these explosive growth numbers that we've seen over the past few years. So I'm going to dig into all this today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So I want to get to the comments that we got from a conference earlier this week. The first is from Toby David, and he said, we're seeing 10% growth quarter to date, year over year. That's 10 times the category growth rate quarter to date. So we feel really strongly about where we're positioned today. We believe the category will bounce back. Basically, there has been no growth in the energy drink category, and a lot of this, they talked about this a lot, was because of weakness in the convenience space. So convenience stores where you go in, you might buy a Celsius or a Monster or a Red Bull, something like that. That drives somewhere around 50% to 2/3 of the volume in the industry. So typically this is a really important category. Traffic is down about 4% in a lot of these convenience stores. So people are just simply going into convenience stores less. And so that's going to put pressure on that business. Those companies are going to reduce inventory. They're going to reduce the amount that they're buying. So that's going to be a negative headwind for a company like Celsius. But they saw 45% space gains within convenience. And so when that business does improve, Celsius should really be there to be one of the beneficiaries. Later on in the conversation, they were talking about this $100 to $120 million loss of revenue in the quarter. So I want to put this into context and show exactly what they said. When we look at the Q3 of last year versus Q3 of this year, we're up 10% year to date, year over year. We're up almost a full share point. So that's the market share that Celsius has in the energy drink category. But just to be precise, 100 million to 120 million figure, we're going to be seeing approximately that in fewer orders from Pepsi in Q3 this year versus Q3 last year. And that is simply because Pepsi is reducing the inventory that they had in their own system. So end customer demand continues to rise, albeit a little bit slower than it was previously. But Pepsi had basically over-ordered what they needed by, sounds like, several million cases. And that's the reduction in orders and inventory that you're seeing from Celsius. So Celsius reports revenue when they actually sell something to Pepsi, not when an end customer buys it. So that's the mismatch that I think we're seeing. Revenue was pulled forward over the last few years as this Pepsi relationship grew, as inventory built, not only in Pepsi, but at retailers. Now we're seeing the backlash to that as inventory is optimized. Now, if you look at some of Celsius's financials, these have been phenomenal over the past few years. You can see that since 2019, compound annual growth rate is 94%. Gross profit has grown faster than that, and so has free cash flow. So focus on those last two numbers. The gross profit number, $751.6 million over the past 12 months. Free cash flow of $245.9 million. What you have with Celsius is a very capital light business. They do not need to increase their amount of manufacturing capacity as they grow the business because they're offloading that manufacturing capacity to co-packers. They're the ones who are actually mixing and bottling the drinks, and then they're delivering it to Pepsi. That's when Celsius actually recognizes revenue. So Celsius, what they're really doing is formulating products, branding, and then building that relationship with both the end customer and the retailers as well. So it's basically a sales organization in a lot of ways. That means it can be very high free cash flow. So if we look at the market cap and the balance sheet, the market cap today, $7.5 billion. And the company has about $900 million worth of cash and no debt on the balance sheet. So that gives management a lot of flexibility when you have points of weakness like this. Do they want to invest in the business in some way? Do they want to simply buy back stock? If shares continue to fall, as I'm recording, shares are trading for $31.77. If shares fall into the 20s, I wouldn't be surprised if Celsius management goes, you know what, we're going to do a huge $400 million share buyback program because we do believe in the future of the company. but it is unquestionable that Q3 is going to be relatively weak. And that's something that investors are going to need to prepare for. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So what should we be thinking about Celsius today? Is this a buying opportunity or not? This is a stock that I actually bought earlier this week. So I'm definitely a buyer, and that was even at a little bit higher price point than we have today. And I think what we need to do is look at long-term what Celsius is building and what the short-term implications for the business are. So I talked earlier about the shortfall that they're going to have in the third quarter. A lot of that has to do with adjustments that Pepsi is making to their inventory in their ecosystem. This is actually something that's been a headwind for Celsius over the past 3 quarters. So this is not something new, but it seems like the scale is going to be even bigger in the third quarter. At a certain point, Pepsi's not going to have room to do that anymore. There's not going to be any more adjustments they're going to be making to inventory. They're going to have to continue to stock their own shelves. So those orders will continue to come back if there is end market demand. And there's no indication at this point that Celsius is losing significant market share in that end market demand. In fact, they're gaining shelf space. They talked about 45% increase in shelf space in retailers. And it seems like that momentum is going to continue in 2025. You also have trends towards sugar-free drinks. You have trends towards energy drinks. You have a trend with Celsius specifically that appeals to a wider audience of users, particularly men drink Red Bull and Monster. Celsius attracts a more female audience. So that is a much bigger addressable market. So you have increased shelf space. You have increased distribution overall. You have a bigger potential market. I think Celsius in time could be even bigger from a revenue perspective than Monster is. That's really its biggest competitor. Now they got a whole bunch of brands under the Monster brand, but Celsius, I think, is going to be able to compete with products more like Pepsi. So a bigger addressable market, and that's what the company is ultimately going after. But there are going to be ebbs and flows in that growth pattern, and that's exactly what we're seeing right now. 2023, we probably got ahead of ourselves as investors, seeing too much growth. Some of that was going to end customers, but some of that was just building out inventory. 2024 is really an adjustment period for Celsius, probably not going to have a lot of top line growth because of that adjustment that's happening with their distribution partners. But 2025, we may start to see those scales tip. And if the consumer starts to buy these kinds of products again, especially at convenience stores, that's the kind of tailwind that we want to see from Celsius. From a valuation standpoint, I think the stock is looking much more attractive. This is the numbers from FinChat right now. Price to earnings multiple is just 31. Remember, this is a company that was trading for over 100 times earnings not too long ago. Enterprise value to sales is just 5. Price to free cash flow is 31 as well. And I mentioned that really strong balance sheet. So add all of these things together, and I think the tailwinds continue to be behind Celsius. Like I said, I bought shares earlier this week, and if we start to get to the point where Celsius shares are trading for 20, 25 times earnings, I think this is the kind of stock that I would absolutely load up on, because I think these short-term headwinds are something that don't indicate the long-term momentum that is behind Celsius. But let me know what you think about Celsius stock today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.